So with the 10-year yield down to 1.5, that could be forecast the economy in the future to only grow at 1.5%. And that'll impact earnings, and share prices are driven basically by earnings. And that leads into another concern that I have with the market valuations right now, is that earnings now, I have it here, might be hard to see on this chart, something I get this data from the S&P, is that you can see here we've had 4 quarters. The S&P calculates earnings 2 ways, top down and bottom up, just a different position. I plot them both. And we've had about 4 or 5 quarters now where earnings have not increased. And so the stocks market has really just been going up on valuations, and we see that in price to book, price to earnings overall in the market. There's one other thing here that I think is a big flaw of what the Fed's been doing over the last, well, really since 2009. We've created a bit of a false kind of economy, or a bigger spread between wealth, because the underlying economy I don't think is as strong as being portrayed, because what a lot of companies have been doing is actually buying back shares. A company has a few options when it has earnings. It can A, reinvest those earnings back into the company, B, it can pay a dividend, or C, it can do a buyback in shares. Buyback in shares was hardly ever done in the past, but this bull market, it's been taken to a whole new level where stock buybacks are almost as high as dividends being paid. And there's actually a new metric now where they look at the combination of the two as the buyback and dividend yield. So I calculated in the last 5 years, if you take the sum of all the earnings from the S&P 500, that there's a negative $123 billion in aggregate that's actually flowed out of companies back to buying stock or paying dividends. That means in aggregate no money has really been invested in the economy, and hence no jobs, again in aggregate, or have been created because the companies haven't been buying machinery or really reinvesting in their company. And what you can see that here, this chart I made up. It does fluctuate from year to year, but we can see in some years just how negative that was. Like I say, over the 5-year period, the net is minus 123 billion. We can see earlier on in the recovery where there was, a net amount of money flowing back into the economy, buy new machinery and invest in the business. So this here to me has become a bit of a Ponzi scheme, in that we see companies now that are buying back shares at extremely elevated prices, and what that does is take away, brings down the book value of the company. It makes the return on assets look good. It makes the earnings per share look good. And typically, a CEO of a corporation is compensated on those metrics more than, say, the price to book ratio. But in the long term, price to book, price to sales, those type of ratios are just as important. So you can see how this links together into not the most ideal for the economy. So we see that the Federal Reserve wants to stimulate. It basically goes to the bank and buys treasuries off, say, a bank, gives them cash in return from that. That cash then sits in the bank looking to make a better investment. So that cash might go into a hedge fund, and that hedge fund might invest in a high growth company and also say to the CEO of that company, well, we want to see the share price go up faster, so we want you to buy back shares. The CEO says, okay, because I'll get the chairman of the board to issue me options, say at $100, and then say 2 or 3 years down the road the shares are $150, he can basically make a 50% profit when he closes out those options. And that's what's been happening. Some of the compensation now for CEOs make more on options than they do from their actual salary. A lot like professional athletes, like Tiger Woods, his actual earnings from golf are minimal compared to what he got from signing agreements with Nike and so on. So seeing that, and that's kind of disturbing. And I've been watching that and looking for companies that are doing that, and it's impossible to short those companies because you get the momentum investors and everybody else that doesn't pay attention to these other ratios, and all they look for is the earnings per share going up, look for the stock price going up, and then they buy more shares. So it's kind of self-perpetuating, and but it has to stop sometime. So I started to do, like I mentioned, some short puts, and I did one on Planet Fitness, which is actually growing. We see the franchises around, and it's done a pretty good job of expanding, but it's the same thing that their balance sheet, if you look at it, is actually negative, which is almost like buying a house for $1 million, taking out a mortgage for $1.2 million, and then hoping that over the next 3 years that house goes up to 1.3 or 1.4 million, and then you're back in the black. So these companies are just looking now that future cash flows will make them assets minus liability positive again, and that'll justify what they've been doing. But I just don't see that happening, and these companies can't maintain the growth rates 20 or 30 years, which it would take in most cases. There's only been a few companies that really can grow, twice or 3 times the economy, and they were like your Google or your Microsofts in the early days. And typically after 10 years, as a company gets bigger, it's harder and harder to grow much above the economy. So what I did on Planet Fitness, I went all the way up to $100 just this August, and basically did a short call, and for that I got $218 for a contract, or $218. And I'm giving myself lots of room. It looks like it might peak out here where it did in the past, and of course if it does continue to grow here, you can start losing money because of other factors if you trade out beforehand. But the worst case scenario, I end up with a short position at 100, and then I'd have to decide what to do, buy back those shares, or. But again, I just figure that coming months, that it's going to be harder for the market to drive too much higher. And I did the same thing too with Fair Isaac, which is kind of a credit rating company in the States. Again, it's been growing pretty good, but again, it's just been parabolic, the growth, and there's no way they can maintain it. So I went all the way up to this case $490 out to July, and for that I did one contract and I got $620, and we're traded today around $421. So I've given myself quite a bit of room. Some of these on the McDye are starting to look like they're probably starting to roll over a little bit, so I do kind of combine it with technicals. And if the market does correct, this is something I will do more of, trying to make some money. The other way is to do just outright shorts, but I've never had any luck with that because you have to get the timing right, and sometimes the premiums make up, take away from any gains that you have. So that's all I really have for this week. Interesting times, and we'll see how things play out, and I'll probably put out another video next week. Thanks for viewing.